Hi everyone, Donna here with Bookkeeping Made Simple. And as promised, today we're going to talk about the balance sheet, why it's important, and why it's so critical to get it right. Also, how it connects with the profit and loss. Tomorrow we'll talk about the statement of cash flows and how all three of those reports work together to help you understand what's going on in your business. So I have a sample company inside it that Intuit provides us inside of QuickBooks that I'm going to use for this. Attention YouTube, this is a sample company. It does not exist in real life. I've had videos taken down because they were afraid that I was doxing somebody, and sorry guys, I have to emphasize, it's a sample company. None of this is a real life company. Okay, so with that, I'm going to go ahead and as always, of course, if you enjoy these videos, please like, share, and subscribe. Hit the red notification bell if you're on YouTube. You guys know the drill. And if you have any specific topics you would like me to cover, just drop them in the comments below. I do read them, and I will do a video on that. So with all that said, we're going to jump over here to this screen so you can see what I'm seeing, and it doesn't sound like just a bunch of craziness. Okay, so going into Intuit sample company. Let's see, share. Okay, going into Intuit sample company, this is the dashboard. This is a non-existent, see right here, guys, it's sample company. Sorry to keep harping on that, but I don't necessarily want this video taken down. We're going to go over here to reports, and then we're going to click on balance sheet. And I'm going to put yesterday's date on the balance sheet because that's what we were looking at yesterday. It's not going to make a difference. Now, the balance sheet is a snapshot of what I'm going to put this over here so you can kind of see me, hopefully. The balance sheet is a snapshot of how your business is doing right now in this very moment. So this is just, what was the business like as far as assets and liabilities and equity on September 11th, 2023. Okay, so we can look through this and we can see there's $1,200 in checking, there's $800 in savings. Those would be the balances, available balances as of the date this report was run. This sample company also has $5,281 in accounts receivable. So they have money that they need to collect from customers that is sitting there in accounts receivable. You notice that is its own asset. We have some other assets over here. We have an inventory asset. So they have inventory or supplies that they're keeping in inventory, not quite $600 worth. They've got that stored somewhere in order to not have to order in new supplies, right? And then we have 2,062 in undeposited funds. Well, what that means is they've accepted payments of 2,062.52, but they have not sent it, they haven't deposited it to the bank in QuickBooks, and possibly and probably not in real life either. Okay. Now, so you notice those are current assets. These are things that's liquid. Fixed assets, they have a truck that they purchased for $13,495. That is what is called the cost basis. Again, if you are familiar with accounting, I apologize for over defining things, but this is meant for beginners. So I really want to make sure that the most basic beginner can understand what I'm talking about without just being bogged down in vocabulary, right? So this was the price that they paid for the truck. We call it a cost basis, and you can see that there's a thing called original cost. This does not have any depreciation listed with it. And usually there would be, I usually have the depreciation as a sub account under the original cost so we can see exactly how those are offsetting each other. So that's the current book value of this truck. We have accounts payable. So they have bills that they need to pay for $1,602 and some change. They have a MasterCard that's listed in the credit card section. They have money that they may owe to the Arizona Department of Revenue. Evidently, this is the Arizona company. So they owe money to a couple of taxing authorities here. This one has a zero balance, and this one has a $370 balance. And then they have a loan that they took out for $4,000 that is currently due. Okay. That is not the same as the note payable. And usually when I am naming these, I don't leave it as just loan payable. I will include the name of the creditor. So that would be for a loan, it would be Chase SBA loan current portion, or something to make it very, very, very recognizable. Because as I'm looking at this, and again, it's a sample company, so I'm not expecting to have a lot of specificity in it. But as I'm doing these for my clients, I want my client to be able to take a quick glance at this and be able to see what the heck is going on in their books. So I want them to be able to recognize the names of the loans and the notes. And most people don't differentiate between notes payable and loans payable. It's not too far off. Then we have notes payable for $25,000. That is a long-term liability. That means we expect to pay that off in more than 12 months. Ideally, the current portion of the note payable will be up here. So that we can see that this is what we expect to pay over the next 12 months. And this is a longer term loan. Okay, so and then the opening balance equity was a negative. Okay, that probably means that they had some balances in their credit cards that they needed to account for. That's what opening balance equity is for. And they have net income of $1,642.46. Now I am going to open another screen on this and look at the profit and loss for the same dates. And this is going to be for as of yesterday. That's when I did this. You'll notice down here, yesterday I went over all of this. But down here at the bottom where it says net income on this is on the profit and loss. See? Profit and loss, made sure the dates were the same. And then I'm going to scroll all the way to the bottom to see the bottom line. Net income, $1,642.46. And then on the balance sheet, it should also have the same. If this business had been, in January, when the fiscal year closes, this number will roll up to here, and the retained earnings will be a cumulative total. Alternatively, the business owner might see that $1,642, and they may decide that they want to reinvest it and end up with zero net income. They may choose to leave it in the company. There's a lot we can do with net income, but it should be the same number on the balance sheet here in the equity section as it is here in the profit and loss bottom line for the same dates. So what does this tell you? I'm going to go ahead and stop the share so that I can just talk to you. What does the balance sheet tell us? Well, the first thing it tells me, this particular balance sheet, this customer is not over leveraged too much. $25,000 is probably a good amount of money to have in long-term liabilities. I don't see a long list of credit cards or loans. When I start to see that, I start to become concerned, because we want the company to be leveraged, but not over leveraged. I mean, it's always great to make money with other people's money. We like doing that, but we don't want to do so much of that we can't make money for ourselves. Because if you're using other people's money, you have to make interest payments. You have to have dividends or something. You have to have a way to pay them back. So be aware of that. What if you're using credit cards and loans to finance your business? It's perfectly okay, so long as you're strategic about it. And so we're going to expect that you're going to have credit cards, that you're going to have loans, that you're going to be trying to push off your payables just as long as you can and collecting on your receivables as quickly as you can. That is, kind of good business sense. But you also have to be very aware of where your money's going. So what I see happening a lot, and I'll probably go into this quite a bit more in a later video because it's in probably multiple videos, because this is so important. What I see happening a lot is people trying to treat their business finance as if it was their W-2 income. So they will take out a lot of credit cards and a lot of loans. They're trying to finance a lifestyle rather than being strategic about how to bring in money for the business that well, let me think of a way to explain that. Let's say you have a trucking company. I've worked with a few of them, and let's say that you or a manufacturing company. Let's make it manufacturing. And as a business owner, you need to know, if I buy this piece of equipment, then how long is it going to take me to earn back that money? Okay. So you need to know, and there's some numbers that we need to run to make sure that that loan makes sense to you. If you've been in business more than a year or two and you're cash flowing, but your cash flow is negative and you think taking out a loan is going to resolve that, then you need to be talking to an accountant before you take out the loan. And we need to make sure that you are able to do that comfortably. We want to make sure you earn back the money of the loan quickly. We want a good return on your investment. We don't do that when we're doing household finances. It's a little bit different thing. Household finances, we have a finite amount of income, and you still don't want to be over leveraged. That's a Dave Ramsey issue then. But either way, you want to be strategic about your use of debt. So I'm going to talk about that a little bit more in a later video. For right now, I'm going to wrap this up. And thank you for watching. Tomorrow, it will be all about the Benjamins. We're going to talk about cash flow. Thanks, and I'll talk to you soon.